Let's have a session on flotation. So flotation is the name in the UK, sometimes outside the UK it's called going public. But either way, what is it? So flotation is the process of a private limited company offering its shares for sale on the stock market to therefore become a public limited company. And the number one benefit of doing that is because you will get access to enormous amounts of external finance because you're on the stock exchange. And on the stock exchange, you have potential investors such as pension funds or investment banks, or it could be high net worth individuals. But they would have enormous amounts of finance to invest in your company. Therefore, you could use this share capital rather than use your retained profits in order for you to look to expand or buy new machinery. So that's a great benefit. Other benefits is it might offer a stable business ownership structure. The reason why is because ultimately these investors, they will have to sell their shares to other investors, but therefore the business remains stable within that transaction. And additionally, during the process of flotation, it's very common for investment banks to underwrite the flotation. And that basically means if there aren't enough demand for shares as you go onto the stock exchange, the investment bank will buy those shares up, effectively insurance. And number three is that becoming a public limited company often is associated with higher prestige. Higher prestige because you get more media coverage, therefore that could lead to higher sales and higher revenue. And number four is that shareholders will retain limited liability. So remember here, because you're going often from a private limited company to a public limited company, they're both limited companies, so limited liability is retained. And finally is that often it's because of the access to external finance and the ability to expand is usually associated with the business becoming larger. And if the business is becoming larger, you may benefit from economies of scale. However, you could get diseconomies of scale. But if you are actually getting bigger, then it might mean that your market share is growing, and that could lead to you having increased brand loyalty. You might be able to increase your prices and overall make more profits. But the disadvantages, the cons of flotation. Well, number one is a flotation itself, the process of becoming a private limited company to a public limited company, is expensive. Expensive for many costs because investment banks will often lead the process and you need to pay them to do it. You need to pay them to work out how much is going to be pursued on the stock exchange, how many shares you're going to issue. Also, an investment bank will have to underwrite the flotation and you have to pay legal fees. So lots of costs involved. And number two is that now anyone can buy shares if you do a flotation. Before you're a private limited company, well, you have control over who your shareholders are. Now you're a public limited company, you do not have control. And that can lead to problems because if managers cannot control who shareholders are, it will increase the risk of two things. Number one is conflicts between owners and managers because they might want to pursue different objectives. And number two, it could increase the risk of takeovers. Takeovers because a rival company may buy up your shares. Beyond that, number three is that it could lead to increased legal requirements because now that you need to meet the requirements of the stock exchange, and you will also have to release more financial information and make it public. And finally is that becoming a public limited company often leads to shareholders that are very myopic, they're very short-sighted, and they might be motivated by short-term dividends rather than long-term investment into the business. And that's a common problem faced by public limited companies. I hope that helps, and I'll see you at the next sesh.